In today's video, I will be talking about the P&L. This stands for profit and loss statement, or also called the income statement. And it is one of the most widely read types of financial statements. Most people tend to find their way around a P&L, even if they don't have any formal finance background. Yet, the P&L has a number of intricacies that makes it really tricky to handle. That standard format of a P&L, it was designed for auditors and tax authorities, but a lot of times it's not so great for understanding how a business actually works. In a SaaS, AI, or tech company, there are three things that make it especially tricky. First, revenue recognition rules mean that what you see on the P&L usually does not match what the company has actually billed their customer, and surely not what has landed in their bank account. Second, R&D capitalization means that the actual cash going into product development can be significantly higher than what shows up as an expense on the P&L. Which is also why a company can actually be showing a profit while simultaneously burning crazy amounts of cash. And third, the standard format often needs to be adapted before it becomes useful. So in this video, we're going to be breaking down exactly how to read a P&L, what's different in a SaaS or tech company context, and what you can do to improve your P&L format. And then finally, I will be walking you through Shopify's actual numbers from their 2025 annual report. And let me quickly introduce myself. My name is Roland Umlauft. I have a degree in engineering and a PhD in finance. And I'm working as a startup CFO and strategy consultant, advising tech founders and leadership teams in early and growth stage companies. Okay, so let's jump in. Last time we talked about the balance sheet, which is a snapshot taken at one specific moment in time. A P&L is different. A P&L covers a period. So usually you would be looking at a quarter or a month or a full year, and the P&L will tell you how much money the business has made or lost during that period. So the basic question the P&L is answering is, did you earn more than you spent? And this is especially important to calculate the amount of tax that you will be paying or not. Other than that, it doesn't easily tell you if your business is actually sustainable. You need to dive into the details to understand that. So first, a word of warning, P&Ls can be structured a little bit different depending on where you are and what accounting format you're using. But regardless of your location and the format that is applied, you will more or less find the same basic P&L structure that I'm showing you today. So let me run you through how this works. At the very top of any P&L, you will be finding revenue. So this is what you sold and what you have delivered. And then typically you subtract your cost of revenue. This is often also called COGS, or cost of goods sold. These are direct costs related to delivering your product. And these costs tend to go up when you start serving more and more customers. Now, revenue minus COGS gives you what's called gross profit. And this is how much money is left after covering that direct cost of delivery before you're spending anything on, let's say, sales, marketing, R&D, or running the company. Now, that gross margin or gross profit gives you the gross margin percentage. And this is one of the most watched numbers in any business. So once we have our gross margin, we're next going to subtract our operating expenses. Usually there are three main buckets: sales and marketing, research and development, and general and administrative. That last segment usually includes things like finance, legal, HR, office costs, etc. Now, some alternative P&L formats would instead show a breakdown like salaries, professional services, and other expenses instead of this, sales, marketing, R&D, etc. However your OpEx is structured, you take that number, you subtract those costs from gross profit, and you get your operating profit. And this is called the EBITDA, or earnings before interest, tax, depreciation, or amortization. Or it could also be EBIT. Here it depends on whether or not you have subtracted amortization as part of your operating expense. Okay, next we're adding financial income and subtracting financial costs. What is financial income? This is typically some money that you're getting from having cash sitting in the bank, so any kind of interest you're earning on your cash position. And financial expenses you would incur if you're carrying debt and you have to pay interest on that debt. So this gets us to pre-tax profit. Take away taxes and you're at the net result or net profit. That is your bottom line of the business. Let's talk next about where tech and specifically SaaS companies are going to differ. First up, that revenue recognition or deferred revenue issue. This is one problem that catches founders off guard all the time. So let me make this a little bit more concrete with a fictitious example. I'm basically starting a imaginary company called TaskFlow. It's a B2B project management in SaaS, and let's assume they're 3 years in. TaskFlow has sent out invoices worth of 11.5 million to its customers this year. But if you look on their P&L, you will only see about 10 million as revenue. Where did that additional 1.5 million go? So here is how this works. SaaS companies often are billing annually upfront to their customers. Let's say we have a customer signing an annual contract at the end of October for $1,200. That invoice is issued on 1st of November. The customer starts using the product and they're paying right away with their credit card. This is great. No? Now, let's fast forward to December 31st. You have now delivered about 2 months of service to this customer. So you should only recognize $200 as revenue for this year. The remaining $1,000 that you've invoiced to the customer becomes deferred revenue, and it will be on your balance sheet. It's a liability actually sitting on your balance sheet. So this is why looking at invoices or cash collections alone is very misleading in a SaaS business. Your cash receipts can grow much, much faster than your reported revenue if you're closing more annual deals. And this is exactly why investors will look at other metrics like ARR, our famous annual recurring revenue, or its twin brother MRR with monthly recurring revenue, or they might be looking at billings or your cash flow statement, etc. Deferred revenue is actually a great thing. It means your customers have committed and they are paying in advance. It's locked in predictable future revenue. It brings down your churn. And a growing deferred revenue balance on the balance sheet is also a really positive sign. Don't be afraid of it, but you have to book this properly. And most companies that are working with subscriptions, once they, start invoicing more than a couple of K a year, are going to make those adjustments. Also, those annual prepayments will significantly increase your cash position. So it's great. Now, what I usually do with my SaaS clients is to add a breakdown in the revenue category, showing an additional line that matches actual billings, and then another line that shows this deferred revenue adjustment right below. Once you sum both together, that is your recognized revenue. I have found that this small adjustment makes it a ton easier to read. And My founders, they love it. Next, let's talk about that cost of goods sold, or COGS. In a traditional business, COGS is really obvious. You're making a product, so you're paying for materials, you're paying for manufacturing, the logistics. That's your cost. But in SaaS, your product is going to live and run in the cloud. So we're not going to the shop anymore to buy Microsoft Office in a big cardboard box on a CD-ROM. So nowadays, if we're a software company, what should your cost of revenue really include? Well, the most obvious is actually the cloud infrastructure. So, think of it that way. Every time a user logs in or runs a query, stores a file, or does whatever, that's compute time on AWS. And that bill is going to grow with your customer base. Nowadays, we definitely also have to include our AI and LLM costs. So if your product uses any kind of, third-party AI, and most products nowadays do, you're going to be paying per token or API call or model run or whatever. So if you've baked in those AI-powered features into your core product, that's a direct cost of delivering the service to each and every single customer. This cost can also be significant, and it definitely has to be included in your COGS. What else? There should be your cost of customer success. And this one actually surprises a lot of people. So the reason for this is that if you have a team that onboards your customers, handles your support, manages renewals, those salaries really should be sitting in COGS, because they're direct cost of keeping customers live on the platform. Now, this matters because it directly determines your gross margin. A typical pure play software company is targeting, 70 to 80% gross margin nowadays. So if your AI costs are high or your customer success team is large relative to revenue, that margin can get quite compressed. And investors tend to watch gross margin very closely, both potential investors as well as your current ones. It tells them how scalable your business really is. As a side note, what I've actually seen in an early stage P&L is sales and marketing and COGS, and this is not correct. The founder actually said to me, but it's the cost of selling the product, so COGS. No, think of COGS being the cost that is directly incurred from delivering the product or service to your customer, but it's not the cost of selling it. Okay, let's take another look at our fictitious company, TaskFlow. Their cost of revenue is $3 million. Now, this comes from cloud infrastructure, $1.4 million. We're having some, AI and API costs of $500,000. We're having a customer success team that costs $900K. And let's imagine there are some other tools for $200K. That gives me a gross profit of $7 million. That's a 70% gross margin. This is solid. The AI costs are eating into this a bit, but 70% is a really respectable number for a growth stage SaaS company. Operating expenses. In our TaskFlow example, we have sales and marketing costs worth about $3 million. They're growing, so they're investing, sales rep, marketing campaigns, content, this is all fine. Our R&D expense, on the other hand, on the P&L looks really low. We're seeing $500,000 here, and we need to be really careful with this. In reality, we're spending $2.5 million on product and engineering this year, not $500,000. And I will explain where that difference went in a moment, so bear with me. Next, let's take a look at general and administrative expenses, or G&A. We're having $1.2 million. This is basically, any kind of operating expenses. And then often there is another line called amortization that could be included in the OpEx, but in many cases, it's actually shown as a separate category. If TaskFlow were a US company, you would probably see amortization included right away in the OpEx category. In our example here, we're having an amortization for a total of $500K, and that is connected to our R&D expense and assets, and it's a non-cash charge. If we include amortization here, we get total of operating expenses of 5.2 million, and we get an operating profit of 1.8 million. This would be called EBIT, as we have already deducted the 500K amortization. Finally, we have financial income and some financial expenses. Let's add 100K net interest income here, and then let's assume that they pay maybe 400K in corporate tax, and that means we get a net profit of about 1.5 million. So that's a 15% net profit margin. Okay, let's come back to that R&D gap and let's dig into that a little bit. This company is spending 2.5 million on R&D, but only 0.5 million shows up on their P&L. Why? This is one of the most misunderstood things in tech company financials. It's called R&D capitalization. The main idea here is that all of those engineering hours that you're paying for, they're actually generating an asset. So this is the code that your software or platform runs on, and it's your product. It's the product that you're commercializing over a long time horizon. So taking this view, should you really count those engineering hours as a cost right away? No, you should capitalize them as an asset and then slowly amortize this cost over a few years. Looking at the accounting rules, so both IFRS and US GAAP are very specific about this, and most accounting rules are, having some direction on what is research, what is development, and how you can capitalize one or the other. So under IFRS and GAAP, research is basically defined as something that is, exploring ideas, running experiments, figuring out what to build. So this is something that's uncertain. You're not actually building anything yet that you are selling directly to the company. Maybe you're building a prototype, but you're not selling that. So whatever you do in research gets expensed immediately as a cost. This hits the P&L whenever you spend it. Development, on the other hand, is different. So this is when you're building something specific, defined product feature, a new module, something where you know what you're making, you expect it to generate future revenue, and you can measure the cost. So in that case, you are allowed to capitalize it. You're treating it basically as an intangible asset on the balance sheet instead of an immediate expense on the P&L. And in our example of task flow, this 2.5 million total R&D spend, we're considering that 500,000 was research, early stage exploratory, and we're expensing that immediately. The other 2 million was development of, let's say, 2 specific new features that are now live. That other 2 million goes onto the balance sheet as an intangible asset, and then it will get amortized over, let's say, 3 years. This company also has been doing this for a couple of years, so they already have some capitalized R&D asset on their balance sheet, and their total capitalized R&D pool is around 1.5 million at this point, which means this year they're amortizing a third of that, which is 500,000 from those prior years. And that is the amount that you see in the amortization line item on the P&L. Okay, why does all of this matter? Because if a company is aggressively capitalizing R&D, then their reported operating expenses are going to look much lower than the actual cash going out the door. That P&L is going to look incredibly healthy, and it will say nothing about the actual cash going out. That is why analysts and investors look at the actual cash investments in R&D, not just the P&L line. And that's why the cash flow statement becomes important. Let's also go back to EBITDA for a moment. You hear this term constantly in startup and investor conversations. EBITDA stands for earnings before interest, tax, depreciation, and amortization. So for our task flow example, net income is 1.5 million, but to get to EBITDA, you add back the tax, 400K. You set aside that interest income for now, and then you add back the amortization of $500,000, and this gives us 2.3 million EBITDA. The idea behind EBITDA is to strip out any financial decisions, interest, accounting rules, tax, all those non-cash charges, depreciation and amortization, and to see really what the core business is actually generating. That is why EBITDA is such an important number and everybody wants to look at it. The problem with EBITDA is also that it can really deceive you. So if you're aggressively capitalizing R&D, as we're doing in our example with task flow, you're moving your cash costs off the P&L and into amortization. So your EBITDA at the end of the day looks really great, but your cash flow does not. And there is actually an additional EBITDA measure that is often provided or asked for called EBITDA cash. And this is basically the standard EBITDA, but with the R&D capitalization added back in. So in the case of our task flow example, this would be 0.3 million. And that's a difference that is significant from the 2.3 million EBITDA, right? 0.3 million EBITDA cash, 2.3 million EBITDA. Okay, so we've covered how to read the P&L, and I already gave you a few tips on how to improve that format. So let's talk a little bit more about how to make this more useful, because the format that you're getting from your accountant or your ERP system is usually not the format that you want to manage your business with. So there are a few things that I personally recommend that you do. First, additionally to showing those billings and deferred revenue accruals, I recommend that you also separate recurring revenue from one-time items. So imagine you had a large professional services contract this year or any kind of one-off licensing deal. These should not sit in the same revenue category as your subscriptions. You want to be able to see your run rate. You want to be able to see what your business generates on a repeating basis without that noise from one-time items distorting the picture. For SaaS companies, a lot of times there are onboarding fees or, configuration charges, something like that. Separate those out from your recurring revenue. Second, break down your COGS by cost driver. Don't just look at a blended line. Knowing that your gross margin is 70% is great, but knowing that, for example, your cloud costs have doubled last quarter, or that your AI or API spend is now 17% of COGS and growing fast, that is actionable information. The different COGS items also tend to scale differently. So building a COGS breakdown that shows those individual drivers gives you an incredible additional layer of visibility that becomes important when you want to grow your company. And third, a contribution margin layer. Add that into your P&L. So basically what I'm talking about is between the gross profit and your operating expenses, consider adding an additional line that shows what's your contribution margin. So this is gross profit minus the variable portion of your sales and marketing spend. By the variable portion, I mean your digital advertising, your sales incentives, or, for example, incentives paid to channel partners. This will tell you what the business is generating per unit of revenue after those direct costs of acquiring and serving customers and before your fixed overhead kicks in. It's a much better number for understanding unit economics and scalability than the standard gross margin line. Now, none of this obviously changes the underlying financials. You're basically just restructuring and adding a couple of relevant details to the same numbers so that this report becomes something useful for decision making rather than just being a compliance and tax report. Okay, let's apply what we've learned and let's go and look at real companies. So like in my last video, I'll be using Shopify's 2025 financial statements. Let's take a look at the P&L. Shopify has two revenue streams. One is called subscription solutions. So this is essentially a SaaS. These are the monthly and annual plans that the merchants pay to Spotify. And this came in at 2.75 billion revenue for the year. The second revenue line that they have is called merchant solutions. And those are payments. This is Shopify Capital. This is shipping, fulfillment, etc. Merchant solutions came in at about 8.8 billion, which gives them a total revenue of 11.6 billion. Also, if we look at last year's revenue, which was already at 9 billion, that is this 30% year-on-year growth. That is significant growth for a company of that size. Now, take into account that those revenue numbers are going to be adjusted for deferred revenues, as we have discussed. So as this company is growing, the actual billings that they've sent to their customers for 2025 will be higher than what they report here as revenue. Okay, cost of revenue. We see that this is a 6 billion item, and that represents 52% of revenue, which means a gross margin of only 48%. That is awful for a pure play SaaS company, but that's not Shopify. Shopify's business nowadays comes from merchant solutions mostly, and those include logistics and fulfillment. And this kind of shipping infrastructure obviously carries a much higher direct cost than a pure subscription software. So this drags this blended gross margin down. If we only look on the subscription side alone, that margin is actually 82%. As should be expected from any SaaS business. We're generating a gross profit of 5.6 billion here. Looking at operating expenses, we have 4.1 billion. This breaks down roughly into 1.7 billion sales and marketing, 1.5 billion R&D, and 471 billion in general and administrative expenses. And then we have an interesting separate line, which is called transaction and loan losses of 417 million. Now, what is that? Those are credit losses on Shopify Capital. So these are merchants who had borrowed from Shopify and they could not repay. So Shopify Capital is actually writing off those loans. And they're treating this as an operating cost of basically being in the lending business here. Okay, we're getting an operating profit of 1.47 billion. That is about 12.7% operating margin. If we look 2 years back, this company was losing 1.4 billion at the operating level. That is a complete turnaround in profitability. Net income, we're at 1.23 billion now. The key takeaways from Shopify. That shift towards merchant solutions obviously is a significant shift in the actual business model. And that has pulled gross margins down from the typical SaaS levels. But this is not a SaaS company anymore. The scale of transaction volumes and the financial services layer, it makes it fundamentally different, and they have created a very, very valuable business model. It just has a lower gross margin, and that is perfectly fine. Now, the operating leverage itself is striking. 30% year-on-year revenue growth is fantastic. Operating expenses themselves grew about 20%. So we're seeing that their margins are expanding really fast. To pull all of this together, a P&L tells you how profitable a business is over a period of time. In a SaaS or tech context, I would say 3 things are really worth watching very closely. First, your COGS drivers, because COGS tells you how efficiently you can deliver your product. Any deterioration in your gross margin is something you have to watch out for. Second, that R&D capitalization, because this can make the P&L look much better than the underlying cash position. So always make sure that you check the cash flow statement or EBITDA cash as well. And finally, deferred revenues, because reported revenue and the actual cash collected are going to diverge significantly, especially if you're closing a lot of annual deals. Okay, that's it for today. In my next video, I will be covering the third financial statement, that is the cash flow statement. If you found this useful, please hit that like button or leave me a comment. If you want more startup finance content, please subscribe and I will see you in the next video.